Welcome back. Average mortgage rates for the month of July just surged to nearly a 21-year high to 6.84%. Excluding October last year at 6.9%, July's reading was the highest since April of 2002. Additionally, it's getting worse because Freddie Mac reported that average rates increased to 6.9% for the week ended August 3rd. It should be no surprise that consumers overall are becoming more pessimistic regarding our U.S. housing market. So for example, based on a new survey from Fannie Mae, they noted that only 18% of consumers believe it's a good time to buy a house. That's not too far off the all-time record low of 16% that was set last year. So in today's video, I'm going to share all the details. Thank you so much for joining me in today's video. I appreciate you. So let's first have a look at our good Uncle Fred here. And of course, the source here is Freddie Mac here. The average rate for the month of July is at 6.84%, which is of course not too much far off the high we saw back in October at 6.9%. But at 6.84%, this is much higher than the record lows that was set back in December 2020 at 2.68%. When looking at the trends here going back to, what is this, the early 1970s, obviously at 6.84%, this is much lower than the highs we saw in October 1981 when the average rate was at 18.45%. Just crazy how high rates were then. But of course, home prices were very, very low, right? But when looking at the trends over the past 20 years or so, zooming in from 2020 here, the monthly rate at 6.84%, the highest rates we've seen going all the way back until April of 2002. And like I mentioned, looking at Fannie Mae's latest survey that was just announced on August 7th here, only 18% of the consumers who responded to the survey here believed it was a good time to buy a house. That's not too far off the all-time record low that was set back in November last year at 16%. Additionally, based on the survey here, 82% of consumers noted it was a bad time to buy a house, a new survey high and up from 78% in June. And here's a look at that right here, a bad time to buy at 82%. This chart here goes back to 2012, as far back as their survey goes. The first survey from Fannie Mae was back in 2012 is what I should say. Anyways, at 82% right now, this is obviously a very high number. And obviously looking at the trough, which is more or less right here, back in June of 2020, only 27% believed it was a bad time to buy a house. Now it has jumped to 82%. When looking at a good time to buy, the percent right now is at 18%, not too far off the all-time record low that was set back in November as well as October last year at 16%. And obviously at 18% right now, this is much lower than the range of 50 to around 75% that we saw in 2012, right up until the end of 2020. Going back to Fannie Mae's survey here, according to Doug Duncan, who's the Fannie Mae's Senior Vice President and Chief Economist, he stated the following: while consumers are reporting confidence in the components related to their personal financial situations, it's unlikely we'll see housing sentiment catch up to the broader economic confidence measures until there is a meaningful improvement to home purchase housing affordability here. I 100% agree with them regarding this because a lot of you guys comment on my channel saying that you guys are sick of high home prices, high rates, something has got to give, right? So there's a lot of people who are waiting on the sidelines right now because they're priced out of this housing market, or they're opting to wait out these challenging conditions we have right now. He also says here in July, a significant majority of consumers indicated that their jobs are stable and that their incomes are the same or better than it was just 12 months ago. However, home buying sentiment once again matched its all-time record low. Consumers continue to attribute the challenging conditions to high home prices and unfavorable mortgage rates. Furthermore, the share of consumers who are expecting that home prices are going to continue increasing has also been on the rise ever since March this year, which may be one of the impacts due to this perception of a lack of housing affordability here. Additionally, they said here, we do not see much movement in the good time to sell component over the past few months, an indication that the current low levels of existing houses for sale will likely continue to persist in the near term, as stated and as reflected in their forecast here. So their forecast is this right here, because as I reported to you guys about a month ago, Fannie Mae stated that the reason why we have a lack of closed home sales is due to a lack of houses for sale. I would say that's partially true. In my personal opinion, let me know what you guys think about this. In my opinion, the reason why we have a lack of closed home sales is due to the fact we have a lack of houses for sale, but also due to the fact that a lot of people are facing headwinds right now due to a lack of housing affordability, which of course is due to the fact we have rising home prices overall, and of course rates at very high levels as well, at around 7% at the time of filming this video here. Therefore, I don't think it's fair to peg that the reason why we have a low level of closed home sales is simply because we don't have enough houses for sale. That's just my personal opinion. So in any case, that's what Fannie Mae believes. It's due to the fact we have a low level of houses for sale. And their forecast for 2023 and 2024 is around 4.2 million closed home sales. Back in 2022, it was at 5 million. So if this actually comes into fruition here, if we have around 4.2 million existing home sales this year and in 2024, that would be a 13-year low. Additionally, that would be about 16.4% lower than 2022's levels at around 5 million. All right, going back to Fannie Mae's survey here, they also asked people, what are your expectations regarding home prices? It says that around 41% believe that home prices will increase in the next 12 months. On top of that, 24% believe that home prices will decrease, whereas 34% believe that home prices will be flat over the next 12 months here. Regarding expectations regarding mortgage rates, approximately 45% believe that rates are actually going to increase in the next 12 months, compared to 38% that believe that rates will remain the same. For comparison's sake, only 16% believe that rates are actually going to decrease in the next 12 months. What do you guys think about that? Please leave me a comment below. Regarding job loss concerns, the percentage of people who said they are not concerned about losing their job in the next 12 months actually increased from 77% to 80%. Also regarding household income, approximately 71% believe their income is going to be the same in the next 12 months. If you guys are curious about some companies' real estate market predictions through 2024, here's what Zillow had to say. Projecting the path forward for the U.S. housing market is difficult at any time, particularly in such unique economic conditions. They are predicting that home prices are going to end 2023 up by 5.5%. Also, they are projecting that we're going to have 4.2 million existing home sales, which is on par with Fannie Mae also at 4.2 million. That would be the lowest calendar year total since the year of 2010. They also expect annual decreases to abate or to lessen by early 2024, and for home sales to stabilize at low levels through early next year. They also believe that elevated mortgage rates will continue to cap listing and sales activity. Interesting dynamics we have right now in our housing market, right? Because we have low rates, which is causing low closed home sales, but also is causing low supply as well, because a lot of people have rates well below 4 and 5%, and they're not going to be selling their houses and taking on a 7% rate when they're locked into historically low interest rates. And as I mentioned in my video from a couple of days ago, according to Black Knight, the average rate for people who have a loan on their houses right now, the average rate is at 3.94%, which is absolutely insane, much lower than the average rates we have today. And that, of course, is one of the main contributors why we have a lack of new supply hitting the market. So if I had to put my real estate market fortune teller hat on, I don't believe we're going to see a surge of new supply or new listings hitting the market unless people are forced to sell their houses. In other words, I don't expect to see a surge of new listings unless unemployment surges as well. Another possible scenario as well is that if rates decrease to around 5.5 or 5% or less, that would also cause a lot of people to get off the fence of listing their houses for sale. That also could contribute to an increase in supply as well. But in that scenario, that also could cause home buying demand to rise as well. With that said, please comment below with your biggest takeaways from today's video. Also, if you guys got any value out of this video whatsoever, then please hit the like button. I greatly appreciate that. Of course, I appreciate you. Hope you guys have an awesome day. I look forward to seeing you on the next video.